Hi guys, and welcome to today's tutorial. In today's tutorial we're going to look at the different types of ownerships that you can have within business, and we're going to look at private limited companies and public limited companies. Remember, you can check out more of our videos on our website examrevision.ie, and you can find more videos on YouTube if you go to youtube.com/examrevision. Okay, so in our previous tutorial we looked at what a sole trader and a partnership were, and then we looked at the advantages and disadvantages of a sole trader and partnership. So today we're going to look at a private limited company. So what is a private limited company? Well, first of all, a private limited company is owned and controlled by a number of shareholders. To be a shareholder, you have to purchase some shares, and you can have up to 50 shareholders in a private limited company. So we're going to look at some of the advantages and disadvantages now. Okay, so some of the advantages that we can get with a private limited company. The first one, the biggest one, is probably that you have limited liability. So you can only lose what you invest in. You can't lose your personal belongings like you can lose in a sole trader and in a partnership. Another advantage is that the business is a separate legal identity to the owners. Okay, so it's separate, so the business can be sued, but it's the business that is sued, not the people, not the owners. It's easier to raise capital because you can do this by selling shares. Also, it's easier to raise capital because banks are more willing to lend to private limited companies. Another good thing is if somebody dies, the shares can be inherited or be passed down to maybe family members or somebody who they choose in their will. And the last one is that decisions are sometimes better made when in private limited companies because there's more people, so expertise can be shared, and people can do the roles that they're specialised in and are more expert in. Okay, so the next thing we're going to look at is some of the disadvantages that you can get with a private limited company. The first one is that it's much harder to set up compared to a sole trader or a partnership. There's a lot more formalities and more forms to fill out than a sole trader or partnership. It's also more expensive to set up compared to a sole trader or partnership. The business is subject to many laws and regulations, which makes it more difficult when setting it up compared to a sole trader and partnership. Again, shares can't be freely sold. Okay, because it's a private limited company, it's not a public limited company where anybody can buy the shares. So there must be certain criteria that people must meet in order to buy shares. And another disadvantage is that your annual financial accounts must be published. Okay, so at the end of the financial year, end of the tax year, your annual returns must be sent to the register of companies, and this makes it public to everybody so everyone can see financially how well you're doing. So this is also another disadvantage. One of the things that comes up on the business Lebenser is the question of how to set up a private limited company. It's quite a common question, and it's really important that you understand how to set up a private limited company. So the very first step in completing and setting up a private limited company is that you need to complete 3 documents. The 3 documents are as follows: Form A1, Memorandum of Association, and Article of Association. So you need to know what each of these 3 forms actually mean as well. So Form 1 basically just outlines the name and the registered address of the business, and it highlights the names and addresses and occupations of the directors, and as a written promise from the directors that they were going to be a director and run the company properly. The second one is the Memorandum of Association, and that basically has the name of the business. It's got the objectives of the business, why it was set up and what its aims are. It's got the amount of capital that is invested into the business. It's got the names of all the directors and a statement that the business has limited liability. And the last one is Article of Association. Article of Association, this document sets out the internal rules and regulations of the company. It describes the voting procedure for meetings, and it sets down the quorum necessary for valid meetings. And just one more thing, it also highlights the voting rights for each type of share in the business. When the 3 documents are completed, they are then sent to the Register of Companies. The third step is that you receive a certificate of incorporation. That's if the Register of Companies are happy and satisfied with your completion of the 3 documents. You will then receive a certificate of incorporation. And this certificate of incorporation is an official license that your company is allowed to trade. The fourth step is to hold the first statutory meeting, and it's compulsory to do this. And at the meeting they will discuss many things, but 3 things that has to be on the agenda is the 3 documents. They have to explain the 3 documents to all shareholders and everyone that's present at the meeting. Each shareholder gets a share certificate, and they also vote in the board of directors. Okay, so there has to be 2 directors in private limited companies, and these are voted in by the shareholders, and they're voted in to be the board of directors. And the last one is that the company can start trading. So once they've done this, once they've held their first statutory meeting, they then start trading. Just a few things to note also about private limited companies. The private limited companies are regulated by the Companies Act 1963 to 1999. 1 share carries 1 vote at each AGM, and the AGM is an annual general meeting. And any major decisions about the business are usually made at the AGMs, at the annual general meetings. I know I've said it already, but the company, its identity is separate to the owners. So if the business is sued, the company can be sued, and it can sue and it can be sued, but the owners can't be sued because it's got limited liability. Okay, so the next thing we're going to look at is a public limited company. So we've now looked at sole trader, partnership, private limited company. We're going to look at a public limited company. So with a public limited company, just some small background. They have at least 7 shareholders, so at least 7 owners are needed to have a public limited company. And there can be an unlimited amount of shareholders. Okay, so like with all the other businesses we looked at so far, there was always like a limited amount of shareholders that we could have. With a public limited company, there's actually an unlimited amount. And they sell shares freely on the stock exchange. So we're going to look at now some of the advantages and disadvantages. So some of the advantages that a public limited company has, and there's many more advantages. These are just a few that I've just noted down. Public limited companies have limited liability, so shareholders can only lose the amount that they actually invest. None of their personal belongings can be taken if the company goes into liquidation, into serious debt. It's easier to raise capital because you can sell shares online. There's no kind of rules or anything stopping them selling shares to anyone in the world. So literally they can sell any share to anyone, and this can enable them to raise capital very quickly. They get lots of media coverage. Okay, this can also be a negative thing, but obviously when the company is doing well and it's very successful, lots of media coverage is very good because it creates a good positive brand image, and it makes more people want to buy more shares, and they can also increase their share price if they are doing quite well and getting a lot of media coverage. They can avail of credit from banks. Banks are more likely to want to lend them money because they can make they know that they have better credit. They can also make quite a lot of money from public limited companies. So banks very often want to be involved with public limited companies. It's very easy to reward and motivate staff with the incentives of giving them shares. Okay, some public limited companies actually give shares to staff in order to motivate them, and if they achieve certain objectives and targets, this is a very good way to motivate staff and make them work harder. And they can also attract top directors and top managers who want to move to the company so they can make a lot of money for themselves too. Disadvantages. There are a few disadvantages with public limited companies. One of them is that they're regulated under law. Okay, so it's very, very strict rules as shares are purchased by the public, and these are regulated under the law by the rules of the stock exchange. They have to do the annual returns, so the financial accounts must be published at the end of every year, and this is made public to the public, and so therefore, if they're not doing so well, people and the public will actually know this, and this may in turn lead to a downturn in the business, because their share price will fall, people will stop investing and buying shares, and this can be quite detrimental to the company. It's very, very expensive to set up at the start. They also receive a lot of media coverage, which is a positive, but if something bad happens to the company, because of the huge media coverage it means that everybody will know what's happened, and this will lead to a decrease in the share price in the stock market. And there's very high costs with running a public limited company. And the last thing is that PLCs, that's public limited companies, are prone to takeover bids, and these can sometimes be a target of like very hostile takeover bids, which can be a bit of a nuisance while trying to run the company. Just one thing to note, with public limited companies, they are PLCs, and with private limited companies, they're called LTDs. Okay, so public limited companies is PLCs, and a private limited company is an LTD, just so you know that. Okay, so that's it for today's tutorial. We looked at private limited companies and public limited companies. If you learned something from the tutorial or found it useful, can you please maybe leave me some feedback just below in the comments on YouTube, or even better if you would subscribe to the YouTube channel. This will obviously make it easier for you to find more videos in the future, and you'll also get some updates and email notices when I upload more videos. You can also find more videos on the website examrevision.ie, and you can subscribe on YouTube, and you can follow us on Twitter and Instagram at Exam Revision for all the latest news. Thank you.